Welcome to the Bulls 2 Bears Insider Trading Podcast. Viewer discretion is advised.
Hello everyone, and welcome back to the Bulls to Bears TV podcast, where we break down the complexities of the financial world to help you navigate the markets with confidence. I'm your host Frank the Bull from bullstobears.com, and today we're diving deep into a topic that's critical for anyone who's invested in the stock market or looking to be. The effects of inflation on stocks, the interplay between interest rates and stock performances, and why right now may be the perfect moment for you to be aggressive with your investments. We'll also touch on the regulatory environment and its impact on stock market performance, with a specific focus on the potential implications of the upcoming election. So let's begin with inflation and its impact on the stock market. Inflation, the rate at which prices for goods and services increase, affects the economy in various ways. When inflation rises, central banks like the Federal Reserve typically respond by increasing interest rates. This response is designed to cool off an overheated economy by making borrowing more expensive. The goal is to reduce spending and investments, thereby slowing down inflation. However, this has significant consequences for the stock market. When the Fed raises interest rates, the cost of borrowing for businesses increases as well. Higher borrowing costs can erode profit margins for companies as they face steeper expenses for financing their operations and expansions. This often leads to reduced corporate earnings, which can prompt a decline in stock prices. Moreover, as interest rates climb, bonds become more attractive investments. Higher interest rates means that newly issued bonds offer better returns, making them a more appealing option compared to stocks at the time. Investors may shift their portfolios to take advantage of these higher yields, leading to a decrease in demand for stocks and subsequently a drop in stock prices. It's a classic example of how the bond market and the stock market are interlinked. When interest rates are high, the bond market tends to perform better while the stock market suffers, and that's what's been happening over the last couple of years. Conversely, when interest rates are cut, the impact on the stock market is generally positive. Now, lower rates reduce the cost of borrowing for businesses, which can lead to increased investments and expansions. Now, with cheaper financing options, companies are often able to improve their profitability, which in turn boosts stock prices. Additionally, when interest rates fall, bonds become less attractive because their yields decrease as well. Now, this shift makes stocks more appealing to investors seeking better returns, leading to increased demand for equities and a rise in the stock market. Now, historically, the stock market tends to react positively to lower interest rates, as it signals a supportive environment for economic growth. Now, given the current context with the Federal Reserve beginning to cut interest rates, it's essential for you to understand why this could be a critical opportunity for investors. Now, as the Fed lowers rates, it's typically a sign that they are aiming to stimulate economic activity. Now, for investors, this creates a favorable environment for stocks. Lower interest rates can lead to increased corporate earnings as businesses benefit from reduced borrowing costs. Additionally, with bonds offering lower yields, investors are likely to shift their investment back to the stock market in search of higher returns. This shift can drive up stock prices, making it a potentially lucrative time for you to invest. Now, let's discuss why waiting to invest could mean missing out. When the Federal Reserve starts to cut rates, the stock market often begins to rise in anticipation of the economic boost that lower rates will bring. Now, if you wait until the market fully reflects these changes, you'll miss out on the initial surge in stock prices. Now, by being proactive and investing early, you position yourself to benefit from the anticipated gains before they become fully realized. Okay, in other words, now is the time to be aggressive and take advantage of the potential upside as the market adjusts to the new interest rate environment. It's also critical to consider the impact of regulations on the market. Regulations can significantly affect business operations and market performance. Excessive regulations can increase operational costs for companies, reducing profitability and create uncertainty in the business environment, and that's what we've seen over the last couple of years. This can lead to lower stock prices and hinder economic growth, which is what we've seen under this past administration. Now, on the other hand, deregulation can have a positive effect on the market. When regulations are eased, companies can operate more freely, potentially leading to increased profitability and more favorable interest climate. Now, in this context, the upcoming election is particularly relevant. If former President Trump wins in November, his stance on easing regulations could be a boon for the stock market. Trump's administration has historically supported reducing regulatory burdens on businesses, which will stimulate economic growth and boost the stock market. Now, a shift towards deregulation under a Trump administration could create a more favorable environment for businesses, encouraging investments and driving up stock prices. This is a deep contrast to the Biden administration that has faced criticism for its handling of economic policies, particularly in relation to inflation and interest rates. Under Biden's leadership, interest rates have soared, placing a significant strain on the stock market and increasing the cost of borrowing for businesses. The higher rates have led to reduced investment, lower corporate earnings, and a sluggish stock market. Critics argue that the Biden administration's policies have missed the mark in addressing inflation effectively, contributing to economic uncertainty and the stock market volatility which we have seen. The rise in interest rates under Biden's administration has a tangible impact on the stock market, leading to decreased stock prices and increased investor anxiety. Now, the higher borrowing costs have not only affected corporate profitability, but also dampened consumer spending, further straining the economy. Now, as the Fed begins to cut rates, there is an opportunity to realize some of these negative effects and stimulate economic growth. However, it is crucial for investors to act swiftly and capitalize on the potential benefits before the market fully adjusts. In conclusion, the interplay between inflation, interest rates, and market performance is complex, but understanding these dynamics can provide valuable insights for us as investors. Rising interest rates generally lead to lower stock prices and higher bond yields. Now, while falling rates typically boost stock prices and decrease bond attractiveness, and that's what's about to happen, people. With the Fed starting to cut rates, the current environment presents a favorable opportunity for investors to be proactive and capitalize on potential gains. Now, additionally, the regulatory environment and political landscape can significantly impact market performance, with deregulation under a potential Trump administration offering a very positive outlook for stocks. The time, people, to act is right now. Do not wait for the market to fully reflect the changes in interest rates and regulatory prices. By being aggressive with your investments today, you position yourself to benefit from the potential upside and avoid missing out on significant market gains. Stay informed and stay proactive. Thank you for tuning in to this episode of Bulls to Bears TV. We hope you found our deep dive into the effects of inflation, interest rates, and market dynamics both insightful and actionable. If you enjoyed today's show, don't forget to like, subscribe, and share it with your friends and fellow investors. By spreading the word, you're helping others stay informed and make smarter investment decisions. As always, your feedback and support mean the world to us, so be sure to leave a comment or a review to let us know what you think. Stay tuned for more episodes where we'll continue to explore the financial trends and strategies that matter most to your portfolio. Also, don't forget to take advantage of our special offer, a 14-day free trial with no credit card required. It's a great way to access exclusive content and resources to further enhance your investment strategy. Visit our website, bullstobears.com, to start your free trial today and see what we have to offer you. Until next time, keep your investment strategy sharp and your outlook positive, people. Happy trading, everyone. I'm Frank the Bull, and this has been Bulls to Bears TV. See you in the next episode. Happy trading, everyone.